It's official. We have entered a new trading era where the old strategies do not work the way they used to. If you have been online, you have probably seen those videos where traders are complaining that they're not making money anymore. They're actually losing because of the new market conditions and that Trump is making them lose. The best traders in the world understand that market conditions can change. In this video, I'm gonna reveal my secret but easy strategy that makes me $1,000 every single day. Not to be arrogant, but this month I haven't lost a single trade and I've made more money than ever in the Trump market. If you are tired of wasting time and money in these markets, then watch this video till the end. With that being said, let's get into the video. First and foremost, we have to understand, why is the market moving? What causes the price to move? If you don't know, the market movers are big banks, institutions, and hedge funds. They have billions and billions of capital. They move the market daily to fill their large positions, and the way they can do that is by taking out liquidity, liquidating people out from the market essentially. Above and below liquidity, there's a bunch of resting buy and sell orders. And the reason why you see these people losing, retail traders losing all the time, is because retail traders will have their stop losses above and below liquidity. And obviously what these market movers do is liquidate them out from the market. It is harsh, but that's the truth. We can take advantage of these liquidity areas by marking them out. And in this video, I'll show you how to do that. And now that we understand why do these markets move, big banks want to take out liquidity, but the way they move to the liquidity areas is by moving in a market trend. And our job is to find the trend and follow it until the liquidity gets swept. And essentially when the liquidity gets taken out, then the market can switch the price direction. That may sound like rocket science right now, but I'm going to simplify it to you in a way that even a 5-year-old could understand it. So I'm currently looking at S&P 500, US 500, okay? US stock index. And we can quite frankly see the market trending right here. The market trends move consistently either in uptrend or downtrend. And we can quite frankly see that, what is this? This is an amazing uptrend, turns into a downtrend. What does it take? Liquidity. Now you may not understand how do we spot liquidity. I'm going to show you very soon, but this is essentially the motive of the market. They will target liquidity and then continue the trend. If we move into the higher time frame, this is just a beautiful uptrend. Okay, everybody's stressing out, but I'm chilling. And essentially I'm a day trader, right? I trade full time. I make money when the price goes up or down. I don't really care, is it going up or down? I make money either way. But now let me show you how can you spot these liquidity areas, and then I'm going to show you how the markets move in trends, right? Liquidity is always resting above highs and below lows. And the way you spot these highs and lows is very simple. You're going to spot an up candle that is immediately followed by a down candle. This is a high, okay? This is where high rests. So here will be buy side liquidity. And then a low, there will be sell side liquidity. A low is being created by a down candle that is immediately followed by an up candle. This is a high, this is a low. Below here is resting sell side liquidity that these big banks want to take. They target that. And here is buy side liquidity that they want to target that as well. And we literally saw that in here. This was a monthly time frame, huge liquidity that got taken out, and now it's starting to move at least momentarily to the upside. And as you can see, these liquidity areas, when they get taken out, they will move the price to the opposite direction, because like I told you, here's millions and billions of orders that these banks have to take out, and the way they can do that is by taking liquidity. And as you can see, this is a monthly time frame low. Why? Because this is a down candle followed by an up candle. Like I showed you in here, this is a low, down candle followed by an up candle. And the thing is, I'm in a monthly time frame, so this has massive amounts of liquidity. Also here is liquidity below these lows. This is also a high, because this is an up candle followed by a down candle. Now I understand, you may wonder like, well, why is this high resting above this down candle? Well, since a high and a low takes two candles to form, we have to choose the more prominent one. So it's above here. Here's high, and this is a monthly time frame. It has massive amounts of liquidity. Higher time frame has more power and influence. And now, as you can see, this market is moving rapidly to the upside. We can literally see by the wick of this candle, after this liquidity, this was a solid liquidity. I could have made a lot of money buying this market after this liquidity got taken out. But the reason why I didn't do that, because yesterday I didn't want to trade because it was Monday. Okay, I personally do not trade on Mondays. Some people could trade on Mondays. I personally don't, because lower volume. And that was a perfect example of a real-time liquidity getting swept in the hard time frame, and that just goes to show you how powerful they are. Literally, liquidity is the lifeblood of the market, as well as the trends. And now I'm going to teach you the trends. What are trends? It's the movement of the price. It's the way these markets move. And I'm going to show you how do these markets move. As you can see, an uptrend, we have to buy in there. Uptrend moves in higher highs, higher lows, higher highs, higher lows, higher highs. It is consistent pattern movement. It moves like this because it can fix the price and move up again, fix the price, move up again, okay? This is when we need to look for buys, because we never want to go against the trend. A downtrend moves in low lows, low highs, low lows, low highs, low lows, low highs, low lows. We have to look for sales in here. This big move of the trend is called a impulse, and then the small move of the trend is called a retracement. Impulse, retracement, impulse, and that's how it continues, okay? You're gonna continue to look for buys in here. And again, impulse, retracement, impulse, retracement, impulse, retracement, impulse. We have to look for sales in here. Every time there's an impulse and a retracement, a high appears. Why? Why is it a high? Because every single time frame has highs and lows, but higher time frame highs and lows have liquidity resting above or below them. But you can also use them to follow the trend if this exact happens, what I'm about to tell you. Remember, a high up candle followed by a down candle. So essentially a impulse retracement, this high appears, and when you see an up candle closing above that, that's when you know that the trend continues. Normally, if it's a liquidity sweep, the high will get swept and it starts to move to the opposite direction. But in the trend, when this up candle closes above the most recent high, that's a breakout structure, BOS, and you're gonna then look for buys if it's continuously moving like that. That's the thing, continuously moving like that. And again, impulse retracement creates the high, remember, high, and when the up candle closes above that, that's a BOS, break of structure. Simple, effective, happens every single day, because that's how these markets move in trends. I mean, let me show you the downtrend, okay? This is a low, because this is an impulse retracement, low, because remember, down candle followed by an up candle. Okay, that's a low. Then when the down candle closes below that, that's a break of structure. Right, like this, break of structure. And the way I like to enter is if it's in a continuous downtrend, and I usually will go to the 1 minute time frame to follow the trend in the session open, New York Stock Exchange open, because there will be volume. When there's a break of structure in the trend, in the current trend, you already see that the trend is continuously respecting this movement. When there's a break of structure, I'm gonna put the stop loss above the most recent lower high, like this, and then I'm gonna target some liquidity areas and follow the trend, because naturally we'll go there, okay? That's how it goes, okay? And then break of structure, they continue and continue. Break of structure happens when there's the low, that is then followed by even lower low, okay? And then it closes. The body of the candle has to close below that. That's a break of structure. You're gonna continue the cycle, rinse and repeat, and in an uptrend, when there's a break of structure, like this, look at this, break of structure, I'm gonna buy right here, if the market is currently moving in that nice trend, okay, previously. And the way you can see that the trend is getting respected is by continuously moving in this trend, okay? Continuously moving in that trend to the upside or to the downside in this kind of cycle. That's how you know that the trend is still solid. And most of the time when the liquidity gets taken out in the higher time frame, the higher time frame lows in this downtrend, for example. So if there's a liquidity, aka higher time frame low, when it gets swept, you might see the trend reversal, just like we saw in the monthly time frame, okay? But I'm gonna first show you in the charts how can you follow the trend, and then I'm gonna show you how can you see the market structure shift with the liquidity. So if we go to the, let's say, 1 minute time frame, we have to first of all acknowledge that we have to trade in the session open. If you trade US stock indices, you're gonna trade in the New York Stock Exchange open or New York session, because there will be the most volume. You have to be trading in there because that's when there's the most opportunities. If you trade Forex or something like that, you're gonna trade in the Forex session hours, right? London, New York, Asian. Right here, we're kind of moving in this sideways movement, but then we start to get some volume to the downside. We can see that what is this trend? This is currently in the 1 minute time frame. How does this trend move? It moves in low lows, low highs, low lows, low highs, low lows, low highs, low lows, low highs. You want to be selling in here in this price action. Why? Because you're gonna follow, then ride the wave. That's how this trend moves and target liquidity. Well, I could have potentially shorted from here because this is a down candle followed by an up candle that is then followed by a body of the candle that closes below that. What is that? A break of structure. I could have shorted from there because it was already moving in this nice downtrend. I could have shorted from here because this is a down candle followed by an up candle that is enclosed by a down candle like this. Break of structure, right? A low that gets breaking below a down candle body. Okay, that's a break of structure. Okay, same thing here. Low that gets breaking below the down candle body. So let's say in this case I would short right in here. Okay, I would put this stop loss above this retracement. So essentially this high, I'll put stop loss above this high, and let's say I would target some liquidity. Higher time frame highs and lows, they have more liquidity resting above or below them. So 50-minute and up, they have lots of liquidity. So let's say if this is a 50-minute low, well, this kind of revealed this already, but this is a 15-minute low, I would target that, and let's see what happens. As you see, boom, that's what I do. And as you can see, this is a perfect example how you follow the trend. And the reason why I target liquidity is because these liquidity areas could potentially switch the market trend. And as you can see, it didn't get reaction. It didn't switch the market trend and start to trend to the upside from this liquidity. This clearly didn't have enough liquidity for them to fill their large positions. So they will target lower, okay? Take some more liquidity. Now I'm gonna show you quickly how you follow the uptrend. Same thing, but to the upside, okay? In uptrend, you need to look for buys, downtrend, you need to look for sells. What do we have in here? This is a pretty nice uptrend right here. This is a nice downtrend. This is a nice uptrend. If we continue to move like this, you're gonna buy. And as you can see, here actually was some liquidity that switched the price direction to the downside momentarily and then continue up. I would want to buy right here because this is, remember, what was this? This is a high because this is an up candle followed by a down candle. Not the most beautiful high, but still it's there. And then this up candle body closes above that. That's a break of structure to the upside. So I would buy, put this long position here, and I'll put this below this low, and I would target some liquidity areas. I will go to the 15-minute time frame. I would target 50-minute high right there. So I would get like almost 1 to 2 ratio, almost. Let's see what happens. I have no clue. There we go. This just goes to show you that these liquidities do have power. It got swept. It doesn't look like a sweep of liquidity, but in the higher time frame, it was a sweep, right? It swept it, went down a little bit, and then continued up. And that's why I target these liquidities. They could switch the price direction momentarily, which like this is kind of momentarily, then it continues up. Or sometimes it could totally switch the price. If it's enough liquidity for the big banks, it will totally switch the trend completely, okay, until it takes more liquidity down. That's like a rinse and repeat. These big banks just rinse and repeat. They move in trends, take out liquidity from buy side, then rinse and repeat, take out liquidity from sell side. That's how it goes, okay? That's how these markets operate. Now, I want to show you an example. How can we spot those trend reversals from these liquidity getting swept and then the price switches? So if you're moving in a downtrend, low lows, low highs, low lows, we want to be looking for sells in here and target this liquidity, right? We're gonna sell in here, target this liquidity. But once this higher time frame liquidity gets swept, then we're gonna want to see a market structure shift. And the way I see that is the liquidity has to be pretty hard time frame. I would say 50-minute and up, okay? And then I want to see something called a market structure shift, like I told you. The way I see that is sweep of liquidity, and then an up, if it's in a downtrend, an up candle body has to close above the most recent high, which is the lower high in this case, okay, in the 1 minute time frame. And then I want to see another one by creating the trend movement, but this is a higher high now in the 1 minute time frame because it broke above this lower high. So then we want to see the retracement impulse. Again, this is essentially two breakout structures. As you can see, first breakout structure and second breakout structure. And I'm gonna buy right here and target liquidity. A buy side liquidity, same thing, but to the upside. First of all, we're gonna look for buys, target this liquidity in this uptrend. Then we have to see the reaction. If the reaction doesn't happen, if it moves like this, if it just continues to moving up, I'm gonna continue to look for buys because that means there's more liquidity to be taken. by these banks. But if it gets swept, and when the down candle body closes below the most recent higher low, right, this is the first breakout structure in the 1 minute time frame. Then we want to see the retracement impulse. That's the second breakout structure. And then I'm gonna sell right here, put the stop loss above this lower high and target some sell side liquidity, and that's how it goes. Okay, that's how I see the trend switch. Now let me show you the charts. I want to give you an example of an uptrend. This is a 1 hour time frame, so keep this in mind. This has a lot of power and influence. So this is a 1 hour time frame liquidity, a buy side liquidity, because remember, why is this a liquidity? Because this is an up candle followed by down candle, a high in the 1 hour time frame. So this has a lot of resting buy side liquidity. Okay, and now if I saw that this got swept, and what we want to now see is we go to the 1 minute time frame. Let's go back before it got swept, right? We go to the 1 minute time frame, and as you can see, it hasn't got swept yet in this 1 minute time frame. But when it gets swept right here, got swept, it looks like a breakout structure, but it's not, because in the higher time frame it's just a sweep. Okay, so we have to see the reaction, right? We have to see the two breakout structures. What happens now? This is our first breakout structure right here. This is a low that got breaking below, and let's see if we see the second breakout structure. There we go. We got the second breakout structure right here. This is a down candle followed by an up candle. Remember, impulse, retracement, impulse. This is now two breakout structures. Now let's be honest, let's be realistic. Would I sell right here? No, because this risk-reward ratio would be kind of trash. That would be cool. Normally I would short right here if it would be a nice reaction, but since it isn't, because we have to keep in mind risk is everything, I'm gonna see a third breakout structure if it happens. Let's see, does it happen? Okay, we actually create a new low. Why? Because this is a down candle followed by an up candle. We need to see the down candle body close below that, and now we got that. This is our third breakout structure. But why is this not bad? Because we continue to respect the downtrend movement, low lows, low highs, low lows. This just confirms that the trend is even more powerful now to the downside. And then what would I do? I would target some 50-minute lows. I would target this, since this is a nice, I really like that downtrend. I'm gonna target this low. Yeah, I'm gonna target that. I'm gonna target this right there. Almost 2.5 risk-reward ratio. I like that. And let's see what happens. There we go. This liquidity got swept. It didn't give us any reaction. So what could I now do? I could potentially short this market even lower, because this broke structure again, continuing to respect the downtrend. And let's say if I just, for example, I would want to get like a 1 to 2 risk-reward ratio. As you can see, the broke structure right here will continue to respect 1 to 2 risk-reward ratio. Let's see what happens. And there we go. We continue to respect the trend. And as you can see, not every low has enough liquidity. This was a 15-minute low, but the thing is, these big banks will then target lower to take more liquidity, and then they can switch the trend, right? Hope that makes sense. If you found this video helpful, comment, like, subscribe, and also if you want your friend or someone else, your family member, to succeed, send this video to them as well. If you think that this video was too advanced, or let's say if you haven't even started trading yet, you just watch this, then click the first link in the description. It will take you to my free beginner trading course. With that being said, I'll see you on the other side. Peace out.